Where are you finding opportunities as people fret about trade wars, trade tariffs and protectionism?
Well, I think the biggest risk is, many people are calling for yields to be moving higher because the Fed is tightening. But I think this is really just, a timely reminder that something unexpected can happen, which has now introduced, real downside risks to growth. And whilst the data in the US has continued to stay strong, elsewhere we are starting to see signs that growth has started to peak out, and none more so than in the UK and in the euro area as well. And we had President Draghi talking about downside risks last week in his press conference, and we may well hear a similar thing from the Bank of England today.
Yeah, we certainly saw some of those central bankers at Sintra worrying about global trade. Manus.
Yeah, good morning to you, Daniela. I suppose the debate is this. Do you want to be longer of treasuries at the short end of the curve on trade war risks? I mean, this is one of the things that we've seen, which is a flow of money, repatriation of dollars into shorter-term ETFs in the bond space. Would you advocate that, which is take on slightly shorter duration risk, or do you want to be? Do you think that will cap out bond yields?
Well, certainly, given the rise in T-bill yields that we've seen, and you start to compare that versus other asset classes, treasuries, in the short end and in 10-year look as though they offer value. For us, we're still looking for 10-year treasury yields to fall towards 2.3% by the end of the year, and that's the place that we feel much more at home owning in that part of the curve.
I've got a chart here that's not about the bond markets, it's about stocks, but I just wanted to use it to make the point about American exceptionalism, perhaps, as we have these trade war conversations. America First, this one is titled, and it just shows the outperformance of the S&P 500 versus emerging markets, versus European stocks, versus Asian equities. And it just raises interesting questions about the extent to which the US does go its own way here. I mean, clearly on the Treasury side, on the rate side, the US has stood apart for some time. How does that develop?
It certainly has, and I think the question so far has been for how long can everything else kind of stay behind, and won't the US kind of boost everything else? I think that question is now starting to shift around, and it's now, for how long can the US remain so resilient whilst the rest of the world seems to be kind of slowing down and topping out?
Daniela, the other excuse me, the other discussion that we had was with Jay Powell in Sintra and a number of other central bankers. They're usually sort of quite prescient in their thoughts. They're worried about the consumer. They're worried about, I suppose, the late effects of the potential trade wars. But what does it do to the inflation story and the break-evens as we look forward? Because that's probably more prescient to the bond market than anything else. Trade wars, 50 billion, trade wars, 200 billion, impact for break-evens in your view?
It's a really tough call, really, because, we've talked about the downside risks to growth which come with the trade wars. But as you say, it's also inflationary. So it's a very, very difficult situation. You have this kind of bad inflation. And to some extent, we're already starting to see the knock-on impact of that. We've had the oil price rise, and we've seen that having a knock-on impact, particularly in the euro area, where consumption has been under pressure. And that's come out in this, the PMIs that we've been seeing in the second quarter, which is having a knock-on impact for growth. So, yes, whilst it's kind of, relatively bullish for break-evens, I think that nominal yields should be relatively kind of capped, given the, the overwhelming impact on growth.